Hello, I am T. Berry, and today we're diving into the world of ETFs, or Exchange Traded Funds. Before we begin, remember, this is not financial advice. I am not a licensed financial advisor. It's crucial to always do your own research and consult with professionals before making any investment decisions. The stock market can be volatile, and investing always carries risks. You should only invest what you're willing to lose, ensuring you're comfortable with the potential outcomes. So, what exactly is an ETF? An ETF is a type of security that tracks an index, commodity, sector, or other assets. It's a versatile investment tool that allows you to gain exposure to a wide range of markets and sectors without having to buy each individual stock or asset. ETFs are traded on stock exchanges, much like individual stocks. This means you can buy and sell them throughout the trading day at market prices, providing flexibility and liquidity. One of the key benefits of ETFs is their ability to contain a diverse array of investments, including stocks, bonds, and commodities. This diversity can help mitigate risk by spreading your investment across different asset classes. By investing in an ETF, you can achieve a diversified portfolio with just a single transaction, simplifying the investment process. This makes ETFs an attractive option for both novice and experienced investors looking to balance their portfolios efficiently. Thanks for subscribing and liking the video. Your support is greatly appreciated, and I look forward to sharing more insights with you in the future. ETFs offer several advantages. Diversification. ETFs typically hold a wide range of assets. Lower fees, generally cheaper than mutual funds. Liquidity. Can be bought and sold throughout the trading day. There are various types of ETFs, including stock ETFs, bond ETFs, commodity ETFs, sector and industry ETFs, and international ETFs. ETFs were first introduced in 1993 with the launch of the SPDR, S&P 500 ETF, commonly known as SPY, by State Street Global Advisors, designed to track the S&P 500 index. Since then, the popularity of ETFs has grown immensely due to their transparency, cost-effectiveness, and flexibility, now reaching trillions in assets under management worldwide. Warren Buffett, one of the most successful investors of all time, has frequently shared his insights on exchange-traded funds, or ETFs. He particularly favors the S&P 500 index funds for most investors, suggesting that these funds are a better choice than trying to pick individual stocks. His key comments on this topic include several important points that can guide both novice and experienced investors alike. Advice on simplicity. Buffett has repeatedly suggested that most investors should choose low-cost S&P 500 index ETFs or mutual funds rather than attempting to outperform the market. He believes that simplicity is key in investing, and that trying to beat the market often leads to unnecessary risks and complications. By investing in a broad market index, investors can benefit from the overall growth of the economy without the stress of picking individual winners. Vanguard, S&P 500 fund. He has praised Vanguard's low-cost S&P 500 index fund as a solid option. Buffett often highlights Vanguard as a pioneer in offering low-cost investment options, making it easier for everyday investors to access the benefits of the stock market. The Vanguard S&P 500 fund, in particular, is a favorite of his due to its low fees and broad market exposure. Long-term focus. Buffett emphasizes the importance of a long-term approach rather than frequent trading, aligning with his philosophy of buy and hold. He argues that the stock market is designed to transfer money from the active to the patient. By holding on to investments for the long term, investors can ride out the market's ups and downs and benefit from the overall upward trend of the economy. Buffett has noted that investors tend to overcomplicate investing and that owning a broad-based index like the S&P 500 through an ETF is a straightforward, effective strategy for most people. He believes that by keeping things simple and focusing on the long term, investors can achieve their financial goals without the stress and complexity that often accompany more active investment strategies. This approach not only saves time and effort, but also aligns with Buffett's own successful investment philosophy. Leading ETF investors include United States. 1. Vanguard Group. Known for its commitment to low fees and long-term performance, Vanguard is a pioneer in index investing. 2. BlackRock. As the parent company of iShares, BlackRock is one of the largest providers of ETFs globally, covering a wide range of markets and sectors. Global 1. BlackRock iShares, the world's largest ETF provider, with funds spanning multiple asset classes and regions. 2. State Street Global Advisors introduced the first ETF and remains one of the biggest ETF managers globally, notably with the SPDR family. When choosing an ETF to invest in, an investor can follow these steps to make a well-informed decision that aligns with their financial goals and risk tolerance. 1. Define investment goals. Start by clearly identifying what you want to achieve with your investment. Are you looking for growth, income, preservation of capital, or are you willing to take on more risk for speculative purposes? Understanding your objectives will guide your choices and help you stay focused on your financial journey. 2. Choose an asset class. Decide which type of ETF suits your needs best. You can choose from stock, bond, commodity, or real estate ETFs. Each asset class comes with its own set of risks and potential rewards. Consider your risk tolerance and how each class aligns with your investment goals. Stocks might offer growth, bonds could provide stability, commodities might hedge against inflation, and real estate can offer income. 3. Research fund holdings and sector. Dive deep into the ETF's holdings. Look at the types of companies, industries, or assets included. Ensure they align with your personal beliefs and investment objectives. This step is crucial for understanding the potential impact of market changes on your investment. 4. Evaluate expense ratio. Examine the ETF's annual cost. A lower expense ratio means more of your money is working for you. Compare fees across similar ETFs to find the most cost-effective option. Remember, even small differences in fees can significantly impact your returns over time. 5. Consider liquidity and spread. Look at the trading volume of the ETF. Higher liquidity generally means lower costs when buying or selling, as it reduces the bid-ask spread. And this can be particularly important if you plan to trade frequently or need to exit your position quickly. 6. Analyze historical performance. While past performance is not a guarantee of future results, it can provide valuable insights into how the ETF has behaved in different market conditions. Look for patterns or trends that might indicate how the ETF could perform in the future. 7. Risk assessment. Finally, assess the risk associated with the ETF. Check for volatility and beta values to understand how sensitive the ETF is to market changes. This will help you gauge whether the ETF fits within your risk tolerance and overall investment strategy. Different types of individual investors interested in ETFs include passive investor. Focuses on long-term growth through index ETFs that track broader markets like S&P 500 ETFs. Day trader buys and sells ETFs frequently, preferring high liquidity ETFs that track volatile sectors or commodities. Fundamental investor chooses ETFs based on financial fundamentals, preferring value ETFs with strong, stable companies. Income-seeking investor looks for bond or dividend-paying stock ETFs to generate regular income. Sector-specific investor invests in sector-focused ETFs like technology, healthcare, or energy for targeted exposure. Thanks for subscribing and liking the video. I appreciate you.